Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Merck stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Merck develops and produces medicines, vaccines, biologic therapies, and animal health products. In 2020, the company had 6 blockbuster drugs, each with over $1 billion in revenue. Keytruda, a humanized antibody used in cancer immunotherapy, had $14.3 billion in 2020 revenue. Januvia, an anti-diabetic medication used to treat type 2 diabetes, had $5.3 billion. Gardasil, an HPV vaccine, had $3.9 billion. Varivax, a varicella vaccine used to protect against chickenpox, had $1.9 billion. Bridion, a neuromuscular-blocking drug, had $1.2 billion. And Pneumovax 23, a pneumococcal polysaccharide vaccine, had $1.1 billion. Other major products by the company include Isentress, an antiretroviral medication used to treat HIV/AIDS, had $857 million. Simponi, a human monoclonal antibody used as an immunosuppressive drug, that had $838 million. Rototech, a rotavirus vaccine, had $797 million. And Lynparza, a medication for the maintenance treatment of advanced ovarian cancer in adults, that generated $725 million in revenue in 2020. The company is headquartered in Kenilworth, New Jersey, and was founded in 1891. It trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Euronext Paris, Xetra, Vienna, EuroTLX, Swiss, Santiago, Bulgaria, Sao Paulo, Lima, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 193 billion market cap. They're trading at $76 a share, and they have 2.5 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have lots of free cash flow every year. It peaked in 2019 at $10 billion. In the trailing 12 months is over $8 billion. Free cash flow is a cash flow that's remaining after paying all your expenses. Net income is the profit or loss on the income statement. It's revenue minus expenses. And you can see they're a really profitable company. Revenue is a sales for the company, and that looks amazing, going from $42 billion to $53 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grows each year, $36 billion in the trailing 12 months. Below that is their operating expenses, and then below that is their operating income. And that's also really solid every year. It was the highest in 2019 at $12.2 billion. That was a great year for this company. It's currently at $10 billion, which is a really high number. Below that is the interest they pay in their debt, and the bottom line of the income statement is their net income, which looks really good each year. Here's their income statement from their latest quarterly report. This shows us the first 9 months of 2020 versus the first 9 months of 2021, and this shows us the third quarter of 2020 versus the third quarter of 2021. So in the third quarter, their revenue was $13 billion, up from $11 billion. The expenses tied to that revenue were $3.5 billion. Then you had selling, general, and administrative expenses. That was $2.3 billion. Research and development is a big expense for this company. That's $2.4 billion. And their operating income was $4.6 billion in the third quarter, up a lot from the third quarter of last year, which was $2.3 billion. Their operating income in the trailing 9 months is $8.5 billion. And that's also up from last year at $7.1 billion. Here's a breakdown of their revenue. And the good thing about this company is they sell all around the world. $6.3 billion of their third quarter revenue was in the US, $3.3 billion in Europe, Middle East, and Africa, $1.3 billion in China, $600 million in Japan. Their revenue in Japan decreased, but it increased in every other country. Here's a breakdown of their third quarter revenue by product. I had to break this up into two charts. I'll show you the second chart in a little bit. Their largest revenue generating drug is Keytruda at $4.5 billion. Keytruda first received FDA approval in 2016. FDA patents are good for 20 years. After the patent expires, the company can still sell the drug, but other drug companies can also sell the drug in generic form. Some of their vaccines have generated a lot of revenue. Gardasil is $2 billion, then $660 million, $300 million, $227 million. Bridion is the biggest in hospital acute care at $369 million. Some Pony is the highest in immunology at $203 million. Here's the rest of their third quarter products by revenue. So the great thing about Merck is they're not a one-trick pony. They develop drugs in a lot of different areas. Neuroscience, virology, cardiovascular, diabetes, animal health. A little less than half their revenue is done in the US. This is the company's statement of cash flows. The top line is the operating cash flow. That's how much cash the company generates from its operational business. And they generate lots of cash flow, $13 billion in the trailing 12 months. They spend a lot of money in CapEx, $5 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And free cash flow is the cash that's remaining for you, the investor. So they do pay a dividend. Another way to reward shareholders is to buy back stock. They bought back lots of stock, $9 billion in 2018, $5 billion in 2019, $1.3 billion, and then $800 million. When a company buys back common stock, it decreases the shares outstanding. It makes your shares more valuable since now you have a bigger piece of the pie. They did decrease their debt load a lot in 2018, but they added debt in 2019 and 2020. In the investing cash flow section, that's where you keep track of their capital expenditure purchases and also their acquisitions, as well as some other things. But in 2020 and the trailing 12 months, their CapEx was a little under $5 billion. So the difference was probably the acquisition of some companies. In 2019, their investing cash flow was less than their capital expenditures. They may have divested or sold some of their divisions. Here's the company's operating cash flows the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with $8.5 billion, we have to add back $1.2 billion of amortization, we add back $1.1 billion of depreciation. They pass through a $1.5 billion gain from their investments in other companies. So we have to minus that out here on a statement of cash flows. We have to add back a charge of Bridion Therapeutics of $1.6 billion, $360 million of stock-based compensation. They had a cash outflow of $3.8 billion in changes in working capital. Even though they had an accounting gain of $8.5 billion, they actually brought in $8 billion of cash flow. Let's look at their investing and financing section. This is the first 9 months of 2020 versus the first 9 months of 2021. So in their investing section, it starts with CapEx, investments in property, plant, and equipment. That was $3.2 billion in 2021. They had a cash inflow of $500 million from the sale of securities. Last year was $1.9 billion. They had a cash outflow from an acquisition on Bridion Therapeutics. In April of this year, the company acquired Bridion Therapeutics. This is a clinical stage biotech company that develops drugs for autoimmune diseases. Last year, they had a cash outflow of $2.5 billion from the acquisition of Arcule. Arcule's focus is on the treatment of cancer and other diseases. And last year, they had a $900 million cash outflow from other acquisitions. In both time periods, they had a cash outflow of $4.5 billion in their investing section. In their financing section, they paid down $4 billion and $1.2 billion of debt. They received $9 billion from the divestiture of Organon. Organon's focus is on women's health. They purchased $800 million of stock in the first 9 months of 2021, and they paid out $5 billion in dividends to their shareholders. So in their financing section, they had a cash outflow of $2.1 billion. Here's the equity section on their 9/30 balance sheet. They have $36 billion of equity. They raised $46 billion from selling their business, and they profited $52 billion from running their business. They also bought back $57 billion of stock. When a company buys back its stock, it takes it off the open market and puts it onto their balance sheet as treasury stock. Treasury stock is a contra equity account, so it brings down your equity balance. Let's look at the capital structure. 36 billion of equity, 26 billion of debt. They're 58% equity, 42% debt. Their net debt is 16 billion. And I gave them the highest whack on Finbox, 6.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 277 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a calculated stock price of 244 billion, and we divide that by 2.5 billion shares. And we get a calculated stock price of $96. They're trading at $76, so they're trading at a 21% discount. It's a buy according to the model. Their revenue is expected to increase 4.6% annually, so I grew their revenue 4.6% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers, and that's 17%. So I multiplied their future revenue estimates by 17%. That's how I got their future free cash flows. Simply, Wall Street's valuation is $229, so they're saying the stock is 67% undervalued. 16 analysts priced this stock, and the average price target is $90. This is where the stock has been trading the last 2 years. It did drop a lot like everything else in March 2020 when the market crashed. It came up to about $100 a share. It's down about 30% in the past month. You would think during a time like this, Merck would be trading really high, mainly because of all the challenges with COVID and the reliance we have on these medical companies developing vaccines and keeping us safe. But for some reason, most of these pharmaceutical stocks are down the past 52 weeks. They have a low beta, 0.49, so the stock moves half the market. It's not too volatile. It's flat the last 52 weeks while the S&P is up 25%. The 52-week low is 68, the high is 91. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. 17 million shares are traded each day. Pretty much all the shares outstanding are on float. 75% are held by institutions, and less than 1% of the shares are shorted. They raise their dividend every year. It was 45 cents in 2017. It's up to 69 cents. And to calculate the dividend yield, multiply the last dividend by 4, take that number and divide by the stock price. Their dividend yield is 3.6%, which is 82% of their net income, 86% of their free cash flow. Their industry pays a 2.4% dividend. They're higher than their industry. Their employee count is pretty flat the past several years. They currently employ 73,500 people. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $30,000 today. That's an 11.5% annual return. 74% of the shares are held by institutions and 25% by the general public. The biggest shareholder is Vanguard at 8%. They own 210 million shares. That's valued at $16 billion. Then BlackRock, State Street, Wellington, and Geode. Let's look at their financial ratios. They have a decent PE at 23, a pretty good price to sales of 3.7, and a decent price to book at 5.4. These are their non-current assets: 400 million of investments, 19 billion of goodwill, 13 billion of other intangibles, and 11 billion of other long-term assets. They have a great return on invested capital, 15%. They can cover their interest payments 12 times. They have a solid ROE at 24%. They have a good current ratio of 1.3, so they can cover their current liabilities with their current assets. But if you strip out inventory, their quick ratio is slightly below 1. They can almost cover their current liabilities with their current assets minus inventory. Let's look at their current assets: 10 billion of cash, 8.5 billion of receivables, 5.6 billion of inventory, and 6.9 billion of other. Let's look at their current liabilities. When their long-term debt is due within 12 months, Then it goes on to current liabilities. That's $3.5 billion. $3.4 billion of trade accounts payable. Trade payables is what the company owes its vendors for inventory related goods. Accounts payable is all of a company's short-term obligations. So if a company reports accounts payable, trades payable is inclusive of that. $14 billion of accrued and other current liabilities. $1 billion of income tax payable. Income tax payable are the taxes due to the government within 1 year. This could include income tax, Medicaid tax, or Social Security tax. This is different than deferred tax liability. Deferred tax liability is a difference between the way GAAP calculates taxes and the way the government, the IRS, calculates taxes. And they have $1.7 billion of dividends payable. When the company announces a dividend payment, they carry that on their balance sheet as dividends payable. When they actually pay out the cash, then they take it off their balance sheet. They seem to be well capitalized. They generated over $8 billion of free cash flow in the trailing 12 months. They have over $7 billion of working capital, and they pay out $7 billion of dividend payments. So they have over $8 billion of funding. So it does appear they can get through the next 12 months without adding any debt or equity. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 15 companies in the same industry as Merck. And if Merck has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So you can see they're better in every category except current ratio. But 1.3 is a fine current ratio. They're better in all the price multiples. Their ROE is a little better than average. They're lower in debt than the average company, and they're a really big company, 193 billion market cap, and they do pay a good dividend as well. So to summarize, I have them trading at a 21% discount. This is a type of stock you should be holding for a long time. It's a great company, they've been around forever, and they're always coming out with new blockbuster drugs. And especially during a time like this, pharmaceutical companies are gold mines. They're so important these days. I rank their free cash flows 8 out of 10, their revenue 9 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.